Oh, 100%. Yeah, be under no illusions here. You got debt levels well above 100% GDP at the public level, and then if you add private, it's another 100, 200 on top of that, depending on which country you look at. So ultimately, the world can't deal with higher interest rates. If we have higher interest rates, then people will essentially go broke. So we have this very low level of interest rates, and that is effectively the function of the new normal. It is low rates, long period of deleveraging, good for asset prices, not necessarily great for the economy. And we've seen that for 5 years, and to be honest, this is just an extension of that. Look, so the US is the most pertinent at the moment, and so the market is assuming that rates are going to get back to sort of 2.5% at some point in the future. I think that's aggressive. You know, they're going to put through the smallest amount of hikes here. And ultimately, again, in Japan, you know, they're trying to get growth back, but they can't actually afford to have rates go higher either. So they're just, rates will be lower for longer. Inflation will be good because that helps you get out of the debt cycle or the debt bust. You reflate away the debt problems. And so central banks are more likely to turn a more blind eye to inflation going forward because that's essentially what they're trying to create at the moment.
The prospect of rates going higher in the US seems to be sort of the event. People don't have a date for it, but the one thing that people are really worried about. How do you see rising rates playing out in the States? Yeah,
look, well, it's the most well-telegraphed rate hike in history. I mean, we've got statements, we've got minutes, we've got the dots, we've got the forecasts. You know, a period of time is defined the other night as 2 meetings, patience as 3 meetings. I mean, it's ridiculous. It is so well telegraphed, and the rate hike will be so small when it does happen that ultimately I don't see it having a huge effect. If rates rise for the right reason, which is growth is getting better, then the economy and the equity market can deal with that. If rates rise for the wrong reasons, because people worry that people aren't going to pay their debts or inflation becomes rampant for some reason, then that's bad for the equity market.